Thank you. Good afternoon, everyone, and I hope you can see me, and I'll share the slides in a while. I think we have basically covered our discussion related to money, and I requested you to go through some of the past paper questions and basically try to answer those questions uh, as a practice, because then we don't need to revise or review all these questions again. So if we can do a couple of things in a good way, then we will be basically in a good position in terms of these past papers, and they are, the broadly the calculations are similar when it comes to monetary aggregate. So I think if you can do one or two questions perfectly, I think you are in a better position in terms of monetary aggregates calculation. I remember I requested you to look at two questions specifically. Were you able to look at these two questions, please? Let me share my slide. I remember I requested you to look at this question. Were you able to do something on this? This is 2015. Yes, 2015 question. Uh, I selected this because of some key things, some important things. Let's see what you have done basically. Right. Now, the question says, consider the following monetary aggregates, monetary and economic information published in the Central Bank Annual Report 2014. So you are given some information related to 2010 and 14, two different years, and we are supposed to calculate some of the monetary numbers, aggregates based on this information. So the first question, answer the following questions based on the above information. First one, calculate base money and broad money supply in 2014. Base money means reserve money and the broad money supply. Were you able to answer this question? What is reserve money supply for 2014? Has anyone done this thing? If you can't talk, even you can type your answers on the chat box. We were talking about this 2014-15 question. Has anyone answered, please? Does anyone want to respond? Does anyone has answered these questions? No one? If not, we will move forward. I'm not going to discuss, because no point of I'm just giving you the answers, and I'm just giving you blindly if you have not done anything. What do you suggest? I think I mentioned to you very clearly that you have to do those two questions, 2015 one and 2019 September question. Remember? What can we do? Usually in this class, I see a lot of interaction. You answer the questions, provide a feedback and all that. But today what has happened? No response. No one. Can somebody, give a response? What can we do? Nothing? I see some names. Can I call by names? Let's move forward and give another week to do it, sir. Ashay. So you think, okay, good decision, suggestion, Ashay. So you think you will do next week? How about others? Sure. Okay. What about others? I need to know others' response as well. Okay. Sadnika says yes. Dina, yes. Kaushala, yes. So you think you can do next week, right? Agreed? Right. So to be clear, if you forget it, write down somewhere 2015 question and 2019 question. Because we need to know how these, monetary aggregates are basically calculated. This is the 2019 March question actually, right? 2019 March. We need to know how these monetary aggregates are calculated and how can we analyze them. So please do it. Otherwise, now there's no point. I'm just telling you the answers. It won't help you. We have to understand it. So please do it next week, right? So I expect you do it next week. If you do it, I'll discuss. If not, I'm going to forget it after next week. Okay. So please do that. Let's move to today's discussion, monetary and money and monetary policy. So can you see the slides? I have put up full screen, so I hope you can see it. Can you?
Yes, sir.
Now, what we do today is actually now from up to last week, we were talking about monetary aggregates, different forms of money, how this money is basically generated or created in the economy, and how the money can be measured. So that's why we calculated these different aggregates, and how money supply in Sri Lanka is defined, and related things we have discussed, and also the sources of money, some key sources of money. Now this week, from this with this discussion, I'm going to close the discussion on money by relating it to the policies of the economy, basically the policies of the central bank, and how money is being used by the policymaker. So that is the purpose of this discussion. And remember, some of your exam questions, some in the sense in every paper, at least one or two questions are there related to this monetary policy. Monetary policy is an important policy affecting the financial sector. So that's why we need to have some understanding about monetary policy and money. Now, money is related to inflation. What do you mean by inflation? Inflation, very simple definition, is the continuous increase in the general price level over a period of time. So to define a particular phenomenon as inflation, we have to observe few things. So there should be a continuous increase in the price. And also not only one price, we are talking about general price level. In the economy, we are not talking about one or two or few prices. We have to look at the entire or the general price level, average price level in the economy over a period of time. So this is how we define inflation. You can keep that in mind very simply. Increase in price level over a period of time. Now, as I said, in the economy, there are number of prices. I think millions of prices are there. Price of vegetable, price of rice, price of a pen, price of a computer, price of tuition, bus fare. Likewise, there are number of prices based on the goods and services we transact in the economy. So based on these transactions in the economy, as there are a number of prices, how can we identify inflation, continuous increase in general price level? For that matter, in the economy, we use price indices. Price indices. But if it is only one, we can call it a price index. So we use index. Index means we take a sample of prices in the economy. We can't measure all these millions of prices. No? We take a sample. Sample in the sense we take a reflective, a representative baskets of goods and services. So in this basket, okay, I don't know how to draw the basket, but let's say this is the basket. We have number of items in this basket. Right? Some are having small weight, some are having a larger weight. For example, if it is food, the quantity in this basket is huge. If it is, let's say, for leisure, we have some few weight. So likewise, there are a number of maybe hundreds of basket items are there. So this basket we select based on a survey in the economy. We try to identify what are the most, popular or used items in the economy. So we do that using a survey. We call it a household survey. Out of this household survey, we identify the basket and we calculate the price of this basket for a particular year. How do you calculate the price of basket? We have the price of items, let's say PI, and we have weights of each items, let's say WI. So by calculating or multiplying price of weight of each and by taking the sigma means the entire basket, we calculate the value for the base year. So let's say in that base year it equals 100, right? So this is the construction of the index. Based on the index, how do you measure the price increase? To do that, you have to take another year. So let's say this is base year, year 0. So you calculate the same price of the basket for another period. Let's say it is time t plus 1. And if you see a difference between these two, that is the price change. So that price change is the measure of inflation. So that can be measured monthly, that can be measured quarterly, that can be measured annually. Likewise, you can measure the price change, this delta P, over a period of time. So when you measure it and you record it, you call it inflation rate. So in Sri Lanka, to do this, we have two major indices used. I'm just erasing these things. So what are these two indices we have in Sri Lanka? To measure inflation, we use one called CCPI. This is Colombo Consumer Price Index. So in this index, we calculate inflation rate based on a sample of households in the Colombo district. That's why you call it Colombo Consumer Price Index. And also, we have another index called NCPI, National Consumer Price Index, where we calculate the prices based on various centers in Sri Lanka. So all 9 provinces are captured in the National Consumer Pricing. So based on this CCPI or NCPI, we calculate inflation rate. So in this chart, we have the inflation numbers and the line. If you look at, the blue line is the CCPI, light blue line is the NCPI. If you look at, both are basically moving in the same way, same direction, but sometimes some index is higher than the other one depending on the prices contained in those indices. So roughly by now, Sri Lanka, I think yesterday or day before yesterday, I think yesterday we have seen inflation rate for the latest month. So I think it's around, as I remember, 3% something, right? So that is how we measure the inflation. And also there are various methods. As I said, you can calculate inflation monthly, on a month-on-month basis. You can see the year-on-year basis. Year-on-year means compared, for example, now this is November. You calculate inflation based on last November. So this point to this point. So you call it year-on-year, YOY. So here you see YOY. YOY percentage change means year-on-year. Sometimes you call it point to point. Sometimes you can calculate the average for the entire period. So you call it annual average inflation. Likewise, in any way, you can see how the prices are moving. Now, if you look at this chart, there are some periods that you see inflation is picking up. There are some periods that we see inflation is going down. Now, these periods, some peaks of inflation, right? Now, this inflation can happen for 2 reasons. One, supply side inflation, which means, let's say, harvest is affected. There's a drought, there is a flood, there's a landslide, disruption to the channels, distribution channels. Or there is an oil price hike. There is, some international prices are going up, like sugar, as I said, oil, rice. So those are some supply side pressures on inflation. So these peaks could be due to supply side, right? And also there is another component of inflation, you call it, I use this highlighter to show that if you take this long-term inflation rates, the numbers, you can simply see a trend. Now, in this case, if you draw a line, probably you will see a trend like this. Okay? That trend indicates inflation driven by demand. So this is the important part for today's discussion. Demand driven inflation. So demand driven inflation means when people demand more and more goods and services, and economy doesn't have that much of goods and services to supply to fulfill that demand, then the prices are increasing. Very simply, the demand supply mechanism. So this is demand supply mechanism. If the demand goes up and no change in supply, what will happen? So these prices would increase to this point. So this is reflected in the demand side inflation. So when there is no adequate supply to cover the excess demand, then the prices would increase. How it happens? That happens when people have more money. For example, let's say you have 100 rupees today. You buy, let's say, a pen today by paying, let's say, 20 rupees each, 5 pens, right, for 100 rupees. Now, tomorrow, let's say you get 1000 rupees and you want to buy pens out of that 1000. Now imagine overnight, that is the entire production. Yesterday you bought 5 pens. Overnight, let's say you can't increase the production of pens. I mean, the economy, there's only 5 pens available. So what happens? You demand more, there's only limited supply. So the pen prices would increase. Now that 5 pens, earlier it was 20 rupees, now it will increase to 200 rupees per pen. Why is that? Demand drives the price. How this demand came out? Because of money income, or the availability of money has increased. So the demand side inflation is basically related to money. So here I have very simply mentioned, excessive demand creates high inflation. So demand is fine. The problem is excessive demand. Excessive demand in a shorter period, you can't fulfill. So that excessive demand is the source for high inflation. How it happens? Through excessive money. So when you have excessive money, more money in your hands, you demand more, and that will lead to increase in prices. Now, let's say I have this simple diagram to understand this. Let's start here. In the economy, let's say you have money supply, M. Now remember I told you in the economy, the velocity, V, is constant over the short term. It's not changing. The speed of circulation will not change. So this part is very simply you can ignore. So money is there in the economy. If you put more money into the system, as in point 2, what will happen? People have more money in their pockets, and then they wish to buy more goods and services in the economy. So in the economy, let's say earlier we had, in our pen example, 5 pens. There was a certain price for that. Now money has doubled or tripled, and still in the economy you have 5 pens. You cannot increase production in a very short time period. So this results in too much money chasing too few goods. So you have only 5 goods, and this excess money is chasing these few goods. So that will lead to increase in prices. So what is our conclusion? Money causes inflation, and this is basically demand driven inflation, as I have already mentioned. Okay? So money is the root cause of inflation. Here we have some examples to understand this. Now, why inflation is bad? Or is it good? Some people would say, okay, inflation not bad. Some people would say, okay, inflation is supportive to the economy. Some people would say, no, inflation is affecting the economy and it's disturbing. So economists agree inflation is fine as long as it's low and manageable. But inflation, especially high inflation, erodes the value of money. Now, money has a certain value, no? So you can buy certain goods and services out of that. You call it purchasing power. So that purchasing power is changing, or it will change due to the changes in inflation. For example, you have 100 rupees today. For 100 rupees, you can buy 5 pens because a pen price is 20. You can buy 5. Let's say in the economy, money uh, income is same, but your pen prices increases for whatever reason. Let's say a pen price would increase to 50 rupees. Now you're only able to buy 2. So your ability to purchase will reduce. It's only one incident. But if you take the entire economy as a whole, in general, that is affecting the entire economy, which means people's welfare. So inflation reduces the welfare of the economy and people's living standard. There are enough evidence to prove this. I have shown a couple of pictures here. Now, the first picture is actually from Zimbabwe. Zimbabwe, this is inflation rate. That inflation, we call it as hyperinflation. Hyperinflation means it's unbearable, uncontrollable, very high inflation, increasing 100%, 200% per day. Now imagine the Zimbabwe case in 2007-8 period. At what particular point in time, inflation was somewhere here. So if you look at this chart and the scale, even you can't read it, I think. It's billion%. So there is a rapid shoot in inflation. At peak, in daily inflation rate was 90%, 98%. So every second prices would change. Every day prices would double. 98% means. So it's huge, rapid inflation driven by monetary expansion, undue monetary expansion. So that reduces the value of money. So this Zimbabwean dollar, I think it's a very good evidence for that. Now this dollar note is $100 trillion. Imagine the size of the currency. Now this $100 trillion means you have to have 100 trillions to buy something. Now would you believe at some point in time the Zimbabwean needed these few currencies, $100 trillion to buy a loaf of bread. So money became that worthless. The second example, the picture, this is from Venezuela, another recent country with high inflation. So with the high inflation, money became very worthless. So these currency notes are on roads. People have thrown away. And I have heard during World War period, prisoners or some people have used currency notes to just to light their cigarettes. The cigarette is much valuable than the currency. So this is due to high inflation. So inflation has to be controlled to keep or to retain the value of money. So in this chart, you will see how the purchasing power would decline at different levels of inflation. Now at 4% inflation, inflation will lead to a reduction of purchasing power like this. At 5%, it's lower than that. At 6%, it's lower than that. Maybe it's 7%, 8%, 10%, it's going like this. So the value of money is eroding at a rapid pace when there is inflation. So how this can be explained? I think we already discussed this thing under money demand theories, quantity theory of money. So that equation can be used to understand the direct relationship between money and inflation. So in this inflation and equation, MB equals PT. Sometimes you call it PY, right? You can call it directly PY. So M means money. V means velocity. I have already defined in couple of occasions the speed at which money is circulated in the economy. P is the price. Y or T, whatever you call it, the output. Right? So MB equal PY. Let's write it in a simple way here. MB equals PY. So in this equation, we make an assumption Y is constant, that is the growth or the production of the economy. V is constant. So when Y and V are constant, you can ignore these two. Only available variables will be M and P. So M is proportional with the P, which means as M increases, P would increase. So increase in money with constant velocity and output would increase the prices. That is the argument. Now I'll come back to this chart again. Now in this slide you have an example. Let's say our overall stock of money is 1000, velocity of money is 2, output is 100. So how do you calculate price level? So if you apply this MV equal PY, we have all inputs here. We have M, we have V, we have Y. So if you input all this information, you can calculate P, the price level. So it's simply MV divided by Y equals P. So 1000 into 2 divided by 10, 100 means 100 is the output. So you get the price level as 20. However, if money was to increase to 2000, which means you are doubling the money, what can you expect? Without calculating, you can say inflation would double. It will reach 40. So you can prove it. So money supply increases to 2000 divided by 2, so multiplied by 2 divided by 100 means 40. So which means assuming that Y and V are constant, any increase in money would lead to an increase in prices. So this is basically money inflation relationship. Now in this chart, I have data from actual countries. So on this axis, I have inflation data. CPI means inflation. On this axis, I have money supply data. Both are growth rates. If you look at, these are dots. This is a scatter plot. And if you plot each and every country against their CPI and inflation, you will see dots like this in this chart, what we call as the scatter plot. And if you take a trend line of these different dots, the trend line is a red positively sloping curve. So which suggests there is a strong positive relationship between money and inflation. If you look at some of the countries, these are some countries, I exactly can't see the names of these countries. If you see, look at this end, you will see their inflation is high because their money level is high. Now here we have another example, inflation is low because money level is low. So there is a very strong case to conclude that inflation is driven by money, as we have seen from these numbers as well. Any question before I move further? Let me check your chat box. Any question? Any clarification? Can we move? Asma, yes, you have raised your hand. Any question? Can you explain the example again, which means numbers, right? Yes, I will do. Here. So in the example, what we ask, we have numbers given, stock of money 1000, velocity of money 2, output is 100. What is the price level? To answer this question, the easiest way and the most possible way for us to use this simple equation, MV equal PY. Right? So if you want to calculate P, it's a matter of deriving P equals MV divided by Y. So M we have 1000, V we have 2, the velocity, Y we have 100. So if you solve this, what you will get? 20. So which means given these numbers, your price level is 20 P. Assume your money was increased to 2000. 2000 means from 1000 to 2000, which means money is doubled. If there's no change in other variables, so you can simply guess the price level. So price level should also double. So if price level is 20, when money is doubled, price level should also be doubled, 40. You can prove it, you can calculate. So money earlier 1000, now it is 2000. Velocity does not change to overall output does not change 100. So if you solve this, you get 40. So when money increases, prices increases. That is the inference or the message out of this discussion. Clear? Are you clear, Asma? How about others? Right. Any other questions or clarification? If not, can we move to the next part of the discussion? Okay, let's move. Now, we know money is having a relationship with inflation. Excessive money is the major root cause of inflation. So, excessive money would lead to changes in price levels, which means prices are becoming volatile. So, such volatile high prices, we call it unstable prices, or when such thing happens, we may call it price instability. Price instability is not good in the economy. Now, for example, in this upper chart, if you look at the variations of the CCPI, this is CPI in this particular country. During this part, you will see the prices are very high and volatile. It's going up, going down very sharply, and also it's high, 15%, 20%. It's a high rate of inflation. So in this part, prices are unstable. or price instability is there, or high inflation is there. So in such situation, there will be a lot of uncertainty and people will not take a decision out of in the economy. So people will not do any, long-term investments. They will not take any long-term economic activities favorably. They will not invest in long-term any other project. No borrowings on the long-term basis. So likewise, a lot of uncertainty will be there when high inflation is there, when price instability is there. So we need to ensure price stability. Price stability is one of the major objectives of central banks in modern world. Major in the sense that is the key objective of modern central banks. What do you mean by that? Relative stability in the general price level in an economy. So which means low and stable inflation. So in this chart, this part, if you look at, inflation is low, it's less than 5% and stable. Stable means you don't see large fluctuations. So in this part, it's not stable. Here, it's very unstable. So in this part, there are some hikes or spikes in inflation, but relatively, broadly, it's stable, low and stable inflation. So that part is having price stability. So you can define price stability as the low and stable inflation. So when price stability is there, there's no volatility. I think in the second chart you can see. So in this period, prices are volatile. You can see how they are moving. So here, price instability. But in the green part, prices are very stable. If you look at, they are moving like this. So they are not volatile. You can predict it. You know, even in the future, it will be like this if things go in the right direction. So this has price stability. So this is a kind of a crucial precondition to increase economic growth and welfare. So people will take economic activities, investments, and a lot of long-term decisions when the prices are stable. So that will lead to the economic welfare of the people. So people will take actions or their decisions based on the price stability condition. So as a result, there will be a very sound environment for economic activity. So if you look at some data, actual data, you call it empirical data, you will see economic growth and inflation has a very good relationship. What does that mean? When inflation is low, you will see economic growth is higher. When inflation is high, then you will see economic growth is low. So there's a negative relationship between inflation and growth, positive relationship between price stability and growth. So when price stability is there, as measured by low inflation rate, that will lead to increasing GDP growth in the economy. So that is basically the notion of price stability, idea of price stability. Now, how this price stability is achieved in the economy? We use a policy called monetary policy. So monetary policy is used to achieve the price stability. Here we define monetary policy. It is actually policy formulated by the central bank. Monetary policy is implemented by the central bank. How it implements basically through influencing the cost and availability of money. Cost and availability of money. What do you mean by cost of money? That is actually the interest rate. We hear some noise. Can you mute, please? Okay. Now it's better, no? Hello? Can you hear me?
Yes, sir.
Right, okay. Cost means the interest rate. Remember when I was talking about money, I had a slide, cost of money. Cost of money means simply the interest rate, the opportunity cost. Availability money means simply the money supply, or you can call it the liquidity. So when monetary policy is implemented, when we say monetary policy is implementing, we are basically controlling level and price of money, which means we control the money supply in the economy or the interest rate, MOI. So monetary policy is targeting this MOI. This is the very simplest way of understanding monetary policy. So basically, as I said, this monetary policy is operated by a central bank. When central bank is operating this monetary policy, it has some objective in mind. The goal variable means the final objective. What is the final objective? The central bank is maintaining inflation and supporting growth. Central banks cannot drive growth, which means the central bank is not in a position to create economic activities. They can't support, though they can't drive growth as the central bank, but they can support growth by maintaining inflation at low levels. So the goal variable is at least to maintain low inflation and support economic growth. And to achieve it, the central bank has some process. There are some instruments, targets, etc., etc. But most important thing for us in our discussion actually these tools. Central bank is having various tools as their instruments related to the monetary policy. So monetary policy is implemented by adopting these tools, right? There are different types of tools, different sizes of tools, the impact. So as the central bank, it employs these tools in its monetary policy making. So central bank can use one or two tools, or it can use a number of tools in combination. So these are actually performed by a central bank. Normally, the governments do not have these tools. For example, the government does not change interest rates in the economy. It is the job or the role of the central bank. Central bank is basically changing the interest rates. Okay. In the next few slides, I'll be discussing these each and every policy instrument in detail. Before that, if you have any question, this is the time. Let me know. Otherwise, we will discuss the tools. Any questions? No questions? Can we move forward? Okay. Right. Now let's look at these tools one by one. First one, policy interest rates. Policy interest rates means, policy means monetary policy interest rates. So these rates are actually named as repo rates, discount rates. There are various names. Sometimes you may have the term central bank rates. Sometimes we call it benchmark rates. So all are basically suggesting they are the base or key interest rates in the economy. Only the central bank can change these rates. Okay? Policy rates can only be changed by the central bank. When central bank is changing these rates, let's say the rates are increased or rates are decreased, then what will happen? That will signal the central bank's monetary policy stance. Or what is the perception of the central bank? Now, if the central bank increases this interest rate, that indicates central bank wants to have high interest rates because these are the benchmark rates. If you see interest rates are going up, then you can think that the central bank wants to have a tight policy, which means they want to control credit. When you increase interest rates, that will increase the cost of money. So money supply will reduce, the credit supply will reduce. So that is basically a tightening of the policy. If it is relaxed, you call it monetary relaxation. These rates are technically used by the central bank, provide liquidity or absorb liquidity, which means liquidity means money in the system, money in the economic system. So there could be excess money or there could be deficit money. So when there is an excess money, central bank can absorb money. When there is deficit money, central bank can supply. I'll come back to that in the next slide. So the policy rates basically are impacting the cost of money. How it happens? When the policy rates are increased, the market rates are also increasing, which means you are affecting the demand for credit. So demand for credit will go down, but the supply of funds will go up because there is an increased market rates, right? So these are called as policy rates. Most of the modern central banks, they are using the policy rates as the main monetary policy instrument. Okay. Then we have the second instrument, open market operations. Open market operations, you may have heard this term OMOs. OMOs. There what happens, central bank is buying and selling securities. Securities means mostly government securities, treasury bills, treasury bonds, things like that can be purchased or sold by the central bank to have an impact on the economy. How it happens? Now I have this simple diagram. Let's say the economy is having a shortage of money, deficit. So when there is no money, shortage, economy can have a recession, which means economic activities are affected, no? They are disturbed. So when they are disturbed, economy will be slowed down. That could even lead to a recession. So how can the central bank support? Central bank is giving money to the economy. And when it gives money, it takes bonds. I already told you government securities in exchange. The central bank doesn't give money for free or without any security. Central bank is giving money to the economy with the collateral or a security from the banks. So then this money goes to the banking system. So whatever the central bank injects through its monetary operations will go to the banking system. So in the banking system now money supply will increase. When money will increase, interest rates will go down. We know there is a relationship between interest and money, negative. Higher the interest, lower the money. Lower the interest, higher the money. So when money supply goes up, interest rates will be low. So individuals and companies in the economy will get money at a lower price. So this is central bank injecting money. Similarly, let's say the economy is having more money plus condition. More money means inflation could increase, isn't it? So in order to control inflation, by avoiding this excess money, central bank can now absorb excess money. So when it absorbs, so money comes back to the central bank. And how does the central bank absorb? Central bank is selling government securities, bonds and bills to banks. Now banks are having less amount of money. Now their money supply goes down and interest rate goes up. Again, that will have an impact on individuals and companies. So this is basically absorbing excess money. So in central bank terminology, we use words repo, reverse repo. So these operations, we call them as reverse repo. Repo, reverse repo means you give money, take a security. On the following day, you give the security and take back money. That is the idea. So this operation is simply called open market operations. That open market operations is affecting the reserve base of the bank. Reserve base means their ability to lend and borrow. That is their basic amounts of money available in the balance sheet. So when the central bank is selling securities, liquidity will be absorbed. When central bank is purchasing securities, liquidity will be injected to the economy. So on a daily basis, a central bank would carry out these open market operations. Sometimes in some countries, not only daily basis, they have even in the morning and in the afternoon. Some countries are having short-term open market operations, which means only one day. Some countries are having, 7 days, 3 months, 1 month, even 1 year. Likewise, that depends on country's central bank arrangements, but otherwise, it is the way of basically borrowing or lending money from the central bank and to the central bank. We call it open market operations. Then we have reserve requirements. I think it's familiar term. That is basically banks are holding some fraction of their deposits at the central bank, and we have already seen and calculated and done that affects the money multiplier. So when statutory reserve ratio is increased, money multiplier will go down, and as a result, money supply will go down. When statutory ratio is declined, money multiplier would increase, and as a result, money supply would increase. I think you have a good memory on this. We have already covered this in a previous session. Other than that, those are the main instruments: interest rates, open market operations, statutory reserve ratio, and there are some other instruments as well. They are used by central banks time to time, and depending on the country situations, they use them. For example, special deposits. Central bank can ask banks to keep a deposit at the central bank. Now, for example, probably you may have heard central bank is imposing margin requirements on banks. Margin requirements means when they import, they have to keep a cash margin, cash deposit at the central bank. So that's why you call it a special deposit. Moral suasion means central bank can call and advise and have meetings with the banks to tell them in a nice way or to influence them in a nice way without taking a hard decision. Direct control means central bank can issue directives in order to attain such and such targets. Now, last few days, you may have seen as the central bank to minimize the pressure of the exchange rate, the central bank has taken some direct controls. Forex transactions means central bank can buy and sell foreign exchange in the market. Now we know the foreign exchange transaction will have a rupee leg also. Rupee leg also means when the foreign exchange transaction is carried out, it will be settled in rupees. For example, if you buy dollars, the transaction will be settled in rupees because you have to inject a similar amount of the other currency. So these are some traditional instruments what we have. Now I have put another two important instruments in the colored shaded area. One is macroprudential measure. So macroprudential means I told you I have used these terms interchangeably where the central bank is using some policy instruments to ensure the resilience of the financial sector. So macroprudential means they are looking at the financial sector as a whole, not only one or two incident or one or two entities. So they look at the entire financial system as a whole and take decisions to prevent any unexpected shocks, to prevent any untermed shocks. So these are called as macroprudential measures. Now, for example, I think I have used these terms earlier also. Loan to value ratio. Let's say a particular person wants to get a loan from a bank. So when you go to the bank will tell you, okay, we will give you 90% of the loan, not the 100%. Or we will give you 50%. We will give you 70%. So when you change that ratio, you call it the loan to value ratio, you will have some additional component that you have to find on your own. If bank is giving you 50%, you have to find out 50%. So most of the people, they don't have that amount to be top up. So in that case, that's a kind of a control for the credit. Then he will decide, okay, I will not go for the credit this time, maybe it's later. So you call these as macroprudential tools that supports the resilience of the financial institutions and the system. Next one, unconventional monetary policy. Now all these monetary policy we have discussed in this area is conventional. Conventional means what we have, tradition. But there are some incidents, some periods, we can't use these traditional tools as it is. For example, in a crisis period, you can't use interest rates, not effective. Now, these days we have this corona pandemic and it's a kind of a crisis situation. So in this situation, we can't use some of these interest rates or liquidity injection and all that. OMO, it's not working. So what is the option, the central banks resort to unconventional monetary policies during extraordinary times. So in those periods, the central bank can do something else. Some countries, there are various ways of doing it. Some countries do a method called quantitative easing. I discussed this thing last week, quantitative easing, where the central bank is buying assets from the, maybe from the public, from the government, whatever, that is to inject money to the economy. Credit easing is also very similar, buying bonds, private bonds, to increase the liquidity. Negative interest rate is also unconventional measure, which means a bank might ask you, okay, we will accept your deposit, but we will not pay any interest. You have to pay your own interest to the bank. So for keeping money, the customer has to pay. So all these are considered as unconventional monetary policies, and they are used in the extraordinary periods where traditional monetary policy tools are uh, not effective. Okay? And then how the monetary policy is implemented. Type. I have already used some of these terms, expansionary monetary policy tool. So when we have expansionary monetary policy tool, what will happen? We increase money, we reduce interest rates. That's the main thing. In a contractionary monetary policy, we increase interest rates and reduce money. That's how it works, expansion and contraction. Expansion means you are giving the support to the economy. Contraction means you are trying to restrict the economic activity. So why? Both are important for price stability. To achieve price stability, central bank is doing this thing. But you can't do both together. Either it's expansionary or contraction, right? You cannot have in between. So that is the direction of monetary policy. The important point is how this direction is decided by the central bank. For that matter, central bank looks at two variables, mainly economic growth, inflation. So if growth is going high, you call it overheating. So when growth is going high, there is a risk that inflation is going up. So as a result, the central bank increases the interest rates to control the economic overheating and high inflation. Opposite, let's say the growth is very slow, it's going down, and the central bank wants to give some boost to the economy because inflation is also low, and as a result, central bank can reduce interest rates. So this is called as expansionary policy or relaxed monetary policy. Sometimes you may have heard these terms also. Relaxed. Tight policy means contractionary. Relaxed policy means expansionary. Central banks are using these things by looking at growth and inflation. So here I have put up some, characteristics under tight and relaxed policies. So in a tight policy, you will see interest rates are going up, money is going down. Aggregate demand, the people's demand will go down, inflation will go down. In a relaxed policy, you want to decrease the interest rates and increase money. So as a result, you will see expansion in demand and increase in inflation likewise. So I'll ask a question. What is the current monetary policy stance of the CBSL? Whether it is tight or relaxed, the current monetary policy stance. What do you think? Can someone answer? Okay, Darshan, relax, get me relaxed. Okay. How about others? What do you think? Does anyone say it's tight? No, it's relaxed. Currently, the central bank is having a relaxed monetary policy stance. I'll discuss that in a while because I got some slides on that. Ashela's CBSL banned cryptocurrency transactions in Sri Lanka as a tool of control inflation, no any other reasons. Now, cryptocurrency actually in Sri Lanka, it's not permitted, not because of inflationary concerns, but in Sri Lanka, we have not taken or accepted cryptocurrency as a medium of exchange. So people cannot use it for transactions. People cannot use it for accumulate wealth because right now the central bank does not see it as a viable way of making payments or doing transactions because there are some issues. Remember when we talk about these cryptocurrencies, I told you some cryptocurrencies cannot be controlled. So if you can't control, that could lead to transactions without the central bank's control, and that could lead to inflation because they are demanding goods and services using that money. So if the money is not regulated, there could be some problem. So at the moment, the central bank has not allowed cryptocurrency transactions. Is it clear, Ashay? Okay. Right. Now let's move to the other slides. Impact of monetary policy. Now, when we take a monetary policy action, that impact is basically felt by the economy. It's moving to the economy. Let's say you change interest rates today, and in the economy also that impact should be reflected. So that process you call it as the transmission process. Changes in policy rates leads to changes in the other market rates. That is what we call as transmission. So the transmission is affecting the various decisions of the financial sector players and ultimately inflation. Remember, this is our ultimate objective. So this is our monetary policy. This is the starting point. This is the ending point. Now from A to Z, there are a lot of steps. These steps are actually the transmission steps. Now, for example, when the central bank is changing monetary policy, the market interest rates would change. So when market interest rates are changing, demand for credit will change. When demand is changing, money supply changes. Sorry, when credit is changing, money supply is changing. When money supply is changing, demand pressures are changing. Finally, inflation is affected. So this entire process, you called it as the transmission process of monetary policy. So central bank is very keen on this, how the monetary policy is basically transmitted to the economy, how it goes to the broader economy, which is the transmission process. And there are various channels. Could be through credit, could be through exchange rate, likewise. I'm not going to detail them because it's an advanced discussion. You may probably learn it in the next session, next level under central banking, but there could be various channels. An important thing for us, monetary policy influences the financial market prices. For example, if the central bank is changing interest rate, that will have an impact on bond interest rates in the economy, share prices in the economy. Now, recent days, people say we have seen interest rates are down in our economy. Interest rates are low. And people say as a result, share market has picked up. Share market is doing well. Every day they are breaking records. The world best performing market, highest ASPI, likewise. Some records are, updated. Some people call it due to low interest rates. So the impact on financial market prices is reflected through such financial instrument prices like the bonds, share prices, or even FD, bank deposits, savings deposits, fixed deposits term. Those are getting changed with the monetary policy changes. Okay. That I think we can discuss our own context, Sri Lankan context. Does anyone want to raise any question before we move? Is anyone having a question? Let me check the chat. Okay, no questions. Let's look at the monetary policy conduct in Sri Lanka. Now in Sri Lanka, who's conducting monetary policy? That's by the Central Bank of Sri Lanka. In Sri Lanka, at the central bank, there are two major objectives. One is, both are related to our topic, our subject, but specifically for today, one of the major objectives is price stability. So it wants to maintain low and stable inflation and also maintain the stability in the financial system. Now, in the economy, the central bank being the main financial institution, they are worried about high inflation and they want to keep inflation at low levels. How the central bank is achieving it? The central bank is conducting monetary policy. So the people in this building, this is the central bank building, and behind you see the Indian Ocean. Actually, now you can't see the Indian Ocean. Now it's almost a post city, right? But this is an old picture. But people in this building, what they do is they formulate monetary policies. Why monetary policy is formulated? To keep inflation low. Why we need inflation low? To support the economic activity, to support investment decisions and all that. Now, when the central bank is doing it, remember I showed you this diagram, this framework, where the central bank is having a goal and instruments are there. So if you apply the same for Central Bank of Sri Lanka, it has a goal. This is the final objective. What is the goal? Economic and price stability, mainly price stability, to keep inflation low. So how the Central Bank of Sri Lanka defines this price stability? Now if you look at this chart, in this chart you will see a blue color band. So this blue color band is called inflation band. So under this inflation band, central bank wants to keep inflation between this range, 4 to 6%. So this blue color indicates central bank is keen to have this 4 to 6% inflation. And these are the actual movements of inflation, this blue red line and the yellow line. And there are some periods the central bank has missed its objective by way of having deviations. But most of the time, if you look at this period during last many years, the inflation has been moving within this band. So this 4 to 6 band, we call that we have in Sri Lanka as a flexible inflation targeting framework, FIT. So if someone asks, what is your monetary policy framework? We can call it flexible inflation targeting. Why flexible inflation targeting? We are trying to maintain this band 4 to 6%. I'll erase it. So we are trying to maintain our inflation within this band 4 to 6. That's why you call it flexible inflation targeting. Now, to keep inflation within this band 4 to 6%, the central bank is using policy instruments. So policy instruments are the tools or the instruments that the central bank has to keep inflation within this range or to achieve low inflation numbers. So in the monetary policy framework, these policy instruments are very clearly defined. What are these instruments? So here we have the whole set of instruments listed, including this moral suasion, I told you special deposits, etc., etc. So even the foreign exchange transactions, they are also used as monetary policy instruments. So this part actually we may call it some having secondary importance, right? I don't say they are not important, but we may call it secondary importance. So what are the most important instruments? These are the most important instruments: open market operations policy rates and reserve requirements. So let's look at them carefully. So Central Bank of Sri Lanka is conducting open market operations. Remember, we discussed this open market operations with that nice picture. Why open market operations are carried out? To absorb or inject money. When economy is in deficit, central bank is injecting money. When economy is in surplus, central bank is absorbing money. This is what we call as open market operation system. So this is happening by way of a kind of an auction system. In this auction, the auction is happening through with the market participants, which are the banks. So central bank on a daily basis, they are conducting these auctions. What are the instruments they use for these auctions? Government securities, I told you. Sorry, government securities, treasury bills, and treasury bonds. So using these, the central bank is conducting open market operations. What is the other instrument? Policy rates. Remember, at the beginning I mentioned there are different names used for these policy rates: central bank rates, benchmark rates, etc., etc. In Sri Lanka, you call it policy rates corridor or standing rate corridor. Now, if you look at this chart, the blue line is a kind of a corridor. So in this corridor, this blue line corridor is the interest rate corridor, the policy rates that we have. So the upper bound of the blue line, blue corridor, you call it SLFR. Lower bound of the corridor, you call it SDFR. I'll define them. What are these rates? SLFR means the upper bound is used to inject money. Let's say there is a shortage in the economy. Banks come and borrow from the central bank at this SLFR, standing lending facility rate. So by that way, the central bank is injecting money to the economy. Clear? And then we have the lower bound, SDFR, which means standing deposit facility rate, that is used when there is a surplus in the economy, more money in the economy. We have to absorb it. Otherwise, it's creating more money, more inflation. So we can absorb it on different terms. So the blue line indicates the blue corridor, this lower bound and the upper bound. So when you have two bounds, it's like a corridor. So that's why you call it policy rates corridor or standing rates corridor. Right now in Sri Lanka, this corridor is brought down to low levels, right? Historically low levels we have right now, and these rates are actually in your exam. So in your exam, this is a very famous question. What are the current SDFR and SLFR rates? Now currently SLFR in Sri Lanka is 5.5, SDFR in Sri Lanka is 4.5. So in this blue diagram, the lower bound is 4.5, the upper bound is 5.5. Okay. Now these rates are reviewed by the central bank regularly. I think 8 times of the year, central bank is looking at these numbers and thinking, or it considers whether it should be changed or not. So depending on the conditions of the economy, whether the rates should go up or go down, the central bank will decide these rates as required by the economic uh, conditions. Now, as I said, any changes in these policy rates are having impact on other market rates. Remember, I called you monetary transmission. So the monetary transmission is happening with the changes in interest rate. To understand the monetary transmission mechanism, we can look at the first line here, the red line. This red line is called as AWCMR, which means average weighted coal money rate. So when the central bank changes its policy rates, monetary policies change, it is immediately reflected in the average weighted coal money rate. When we discuss the markets, I'll explain more, but very simply, that is the average interest rate for all the banks who are in the coal money market rate. Coal money market means on a daily basis, there is a market between the bankers to borrow and lend money. So in that market, if you take an average rate, you call it average weighted coal money rate. Central bank is trying to keep this average weighted coal money rate as much as possible at the middle of the corridor. They are trying very hard to keep that rate in the middle. The reason is that is a kind of an indicator for other rates. When that rate goes down, maybe other market rates are also following. If that rate goes up, maybe other rates are also following the same. So it's a kind of an indicator for the market, AWC. So this is what's happening under open market operations. I told you open market operations are carried out using these interest rates to absorb liquidity when there is an excess, or to inject liquidity when there is a shortage. So now in this chart, if you look at, there are some periods. For example, this period we have large surplus money in the economy. So this surplus money in the economy indicates there is an excess money. So during such periods, the central bank is basically absorbing the excess. And in some periods, for example, if you look at these yellow bars areas, you will see it's a negative sign, which means central bank is observing money shortage in the economy, which means no money in the economy, enough money in the economy to carry out the economic transactions. So in such case, the central bank is basically injecting money to fill up the shortage. So when the central bank is absorbing excess money and injecting deficit money, that is helpful to keep the interest rates without much variation. If the central bank wants to keep interest rates at stable levels, they can use these open market operations. Right? So that is simply a money absorption and injection activity carried out by the central bank. Under open market operations. Then statutory reserve ratio. I think we already know what is statutory reserve ratio. Banks are supposed to keep a certain percentage at the central bank as a deposit. So in Sri Lanka, all demand, time and savings deposits of commercial banks in rupees, they have to keep a percentage as SRR at the central bank. So which means by every 100 rupee, the commercial bank should keep 2 rupees at the central bank. Now currently it is 2 rupees because we have reduced, the central bank has reduced that to a low level, because when you reduce it, you inject money to the economy. So during coronavirus period, we know people needed money. The economic activities required money. So while reducing interest rate, the central bank has been injecting money by way of reducing the statutory reserve ratio. So these are the major instruments, as I said, the policy rates, open market operations, statutory reserve ratio. You should have those things in mind. Other instruments, actually, we are not discussing too much in this level because they are actually discussed in detail in the central banking unit. So these are the most used instruments: policy rates, open market operations, and SRR. Now here, using this SRR, you are able to calculate the money multiplier, isn't it? Now, if our simple equation is true, at the current level 2%, money multiplier should be how much? 50. 1 divided by 2% means it's very low. So it's creating more money in the system. Now, when the central bank is taking these policy decisions, monetary policy changes, they are actually communicated to the market. So in that sense, central bank considers monetary policy communication as an important element, important activity in the uh, monetary policy process. Why? Whenever the central bank takes a decision, it has to be communicated to the market. Otherwise, market wouldn't know. So central bank is doing it by way of issuing a press release. This is only one thing. There are various other communication modes: press conference, putting it on the website, a Facebook updates, people talking, likewise. But the main method of releasing the decision is monetary policy press release. Now, my request, you keep a special note on this monetary policy press release, because before the exams, actually, during your study, it's really important you look at this press release. Because sometimes you don't know policy rates are changed. Remember those rates I mentioned, SLFR and SDFR. So if these rates are changed, you don't know unless you read this press release. So this is available in the central bank website, www.cbsl.gov.lk. So it's really important that you look at the central bank website and especially look at this press release. It's only 8 times per year. In every year, 8 times we are announcing it. I think the recent one was announced 2 weeks back. The next one will be in February. So there you will see a lot of information, even what would be the future inflation. Now in this latest press release, we have this chart. It says going forward, what will be our inflation? Is it going up or going down? Based on current forecast, in the next 2 years, we will see inflation is basically, flat, which means there will be no pressures on prices as per the current estimates. That could change in the future, but at the moment, what we see is no inflation in the future. So there's no pressure. So investors or policymakers or market players, they can have a very confident decision by looking at this monetary policy uh, communication. Right now, now this is the current monetary policy stance. You told me, central bank is having a relaxed monetary policy. Someone mentioned in the chat, central bank is having a relaxed monetary policy stance right now. That's correct. Central bank is having a relaxed monetary policy stance. Why it has relaxed the monetary policy? Because two reasons. First thing, economic growth is low. We know during last many quarters, our economic growth was basically indicating a lower performance. Even this year, economy is negative, right? Second quarter, I heard it's like 16.8 negative. So the economy needs some support. How can you support? You can reduce interest rate, you can inject money. So then the people will start borrow, economic activities would happen, investments would happen. So economy will revive. That is one reason, low growth. Second reason, central bank can relax monetary policy because inflation is low. Now, if you look at this chart, we will see inflation is not a major threat. Here, we will see inflation is roughly around our band. Even in this chart, we have seen, we call it a fan chart. In this fan chart, we see inflation in the future will be around 5%. So no major threats to inflation. So as a result, we can have, considering low growth and low inflation, we can relax the monetary policy. So central bank has done relaxation of monetary policy through various measures. So in this slide, these various measures are basically included, but I will just highlight a couple of points. First thing, central bank has reduced interest rates. You can see interest rates have taken down from the previously high levels. In 2018, interest rates were around 7-8%. Now 2021, interest rates are around 4-5%. So which means policy rates are reduced. That's one measure, right? Second measure, I think policy rates are reduced by 200 basis points, 250 basis points, which means 2.5 percentage point. SRR, statutory reserve ratio, has been reduced by 300 basis points, which means 3 percentage points. So it has been reduced largely. Third point, this is market liquidity. Market liquidity means injecting money to the economy. Now, if you look at this chart number, around 200 billion, 887 billion, let's say around 200 billion has been put up to the economy by the central bank. So that's a massive amount of money. Large amounts of money is put up or injected to the economy by the central bank, and central bank has encouraged banks to reduce their interest rates. Central bank has given some directions, some interest rate caps, requests, some warnings. Various measures were given to the financial sector to bring down the interest rate. Now what we see, interest rates have come down drastically. Interest rates are at very low levels in the economy. So if you look at this chart, you will see the first line we have treasury bill rates. Treasury bill rates are around 4-5%, very low, historically low. Now if you look at this chart, from 10% to around 4.4, 4%. Other market interest rates from about 15% higher rates, now they have come down to around 10%, 9%, 10%. So more than 5-6% reduction in interest rates has happened due to the relaxed monetary policy stance. So I think you are very clear what the central bank has done in terms of policy relaxation measures. Now here we have various interest rates, AWBR, DR, etc., etc. I'm going to discuss these different terms next week. But overall, from this chart, you will see interest rates have come down over the period due to the monetary policy relaxation measures. Now, after that, you have some questions. You can go through these questions. Now, look at, as I said, you have to know the numbers. What is the level of stand-in deposit facility rate of the central bank at present? So normally I give it to you in the class. I just told you 4.5 is the SDFR. But be mindful, before your exam, this could change because central bank is changing this rate time to time. Right now, standing lending facility rate is 5.5. But it doesn't guarantee at the exam also you can write this. It may be changed before your exam. So you need to know, for that matter, you need to look at the press release of the central bank. Okay? And here, very similar questions are there. Now remember, I gave you this question. Statutory reserve ratio is 10%. What is the credit multiplier? So it's a matter of 1 divided by 0.10. So the answer is 10. Remember? So we have done these things in the class, and there are some money related questions. Now look at this question. Why do central banks conduct monetary policy? Briefly explain the major instruments. Now remember, I discussed why the monetary policy is important. And I also discussed what are the key instruments like policy rates, open market operations, statutory reserve ratios, etc., etc. And here, what is meant by open market operations? I just discussed that is basically absorbing or injecting money to the economy by the central bank through its market operations. So I'm just giving you some flavor, but you should be able to answer these questions by looking at these or by following my discussion. So with regard to monetary policy, that's all I have. I actually wanted to cover this discussion today itself, and I completed it because we don't need to spend too much time on these things because they are very straightforward and also very straightforward questions there. Now, before we wind up for the day, I may allow few questions if you have, because we have a couple of minutes left, 10 minutes there. So if someone wants to raise any question, it's the time. Any clarification, you can just ask me before we close for the day. Any questions? Nothing? All clear? If everything is clear, I'm really happy, but you need to make sure that you understand everything very perfectly, and you should be able to answer any question from these past papers based on this discussion, right? Now if you don't have any more questions, let's wind up here. And as somebody has already mentioned, I will see you next week with the answers to the questions. I really want you to answer. If not next week, if you don't answer, I will not touch it again, because I don't want to spend time on that if you really don't have the need to discuss it. To discuss it, you should try it. That's my point. Okay. So let's meet up next week at the same time, 3:30 next Saturday. And until such time, I wish you a very good week ahead. Thank you. Good night.